Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, AI capex in focus after Meta, Microsoft and Tesla all report earnings with mixed fortunes.
Plus, Apple is also set to report earnings later today with holiday season results and the impact of memory prices top of mind for investors.
And Amazon reported hundreds of thousands of pieces of content it believed included child sexual abuse material, which it found in data gathered to improve its AI models. We have the Bloomberg reporting.
And it is significant in reporting at that. But let's turn our attention to what's happening on the markets right now, Ed, because it is a tough day to say the least. It is all about capex in AI, and you're going to go there with the individual names. But I point to a NASDAQ 100 that's having its worst day since November of last year. 2 months now, we're down by 2 percentage points. Some huge moves on individual names, but crypto also languishing. We're off by 5%. We're at 84,000 at the moment. So much for being in digital gold in this currently debasement environment. It ain't working out for this particular area of gold because now it's just working as a risk asset. What are you looking at?
Look, since we've come on air, there is a bit of a vibe shift or a deepening of concern around AI capital expenditures. Two very similar stories, but stocks going in different directions. Meta told us this year $135 billion of capex, but showed in the current period and beyond significant growth, particularly in the ad business, that justifies it. Microsoft, capex $1.5 billion beyond consensus in the quarter gone, but 38% growth in Azure, the cloud unit. That's the one we look at for the AI progress. On a constant currency basis or currency adjusted basis, it's basically in line with estimates. And people are worried that this growth in capex is outpacing what is now decelerating growth in Azure for the time being, Caro. Much to dig on here.
There is, and we've got the perfect person to do that with. Let's bring in Gabriela Borges, analyst covering the emerging software sector within Goldman Sachs' Global Investment Research Unit, maintaining a buy rating on Microsoft, citing long-term strategic AI positioning. So do we have to swallow the 66% increase in capex on the quarter for long-term rewards with Azure that just aren't showing up quite yet?
Yes. Hi, good morning. That's exactly the question that investors are asking us. What's really interesting is this is the second quarter in a row where Microsoft is actually telling you there is a more nuanced way to think about their capex allocations. Typically, what you would expect to see is capex goes up, Azure revenue goes up. There's a really direct correlation. What's happening in reality is Microsoft is telling you there are two important strategic priorities in addition to Azure revenue. The first is Microsoft Copilot and what they're doing in the first-party apps ecosystem. As Copilot adoption goes up, so does the capex allocation that has to go to support that business. The second is what they're doing with internal R&D. So think Microsoft AI, for example. Very strategic imperative because if they get some of these new markets right, like medical diagnostics, for example, that could be a really interesting long-term product cycle for them as well.
Amy Hood tried to get that nuance across in the earnings calls, saying, look, we could have had markedly bigger percentage growth for Azure if we'd served external clients, but we're serving ourselves with the compute. Why do we see the market overreacting like this, even with that nuance?
Yeah, it's a trade-off between short-term and long-term. Short-term, you see that in the Azure revenue number every quarter. Longer term, though, something like Copilot, that's a gross margin accretion cycle and a long-term monetization story that happens over multiple years. Microsoft AI, that's something that you're going to get maybe a couple of blog posts this year, a couple of really exciting data points, but it's hard to predict when exactly you'll get those data points. So the way we see this is there's a little bit of a short-term negative reaction here because it's hard to see into the future. Ultimately, we do still believe the data points will accrue positive on those two other strategic initiatives.
Let's go back to basics a bit, Gabrielle. And Caro, we talked about this before the show. This is a drop of 12%. So this is the biggest drop in the stock since March of 2020. $429 billion of market value wiped off. That suggests serious concern, Gabriella. What do you think is the counter-argument to that concern in the market?
Yeah, I do think it's going to be a more balanced evolution on what enterprise AI adoption looks like this year. We know for 2 years now it's been a real struggle to see adoption tick up on the enterprise AI side. There's a lot of heavy lifting that has to happen on the data architectures, the data infrastructure, marrying some of these really cool LLMs with the richness of an enterprise context, and that's taken time. So as we go through 2026, one of the data points we'll be looking for is that enterprise AI adoption starting to go higher? And what Microsoft told you last night is actually they have an increasing uptick on adoption on the Copilot side. We've seen data points on Claude Cowork as well, just in the last couple of weeks. You put all of that together with what ServiceNow is saying last night, and there is starting to be enough critical mass to suggest that enterprise AI adoption will go up from here.
Net income was boosted by a gain in Microsoft's investment in OpenAI, lifted per share earnings by $1.02, right? But at issue here is still how Microsoft manages the capacity issue that OpenAI presents them, as well as the circular financing issue, right? That, that's the arrangement. Here is some capital, and here are the services that we'll charge you for as well. How do you think about that, Gabriella, and whether we now shift OpenAI a bit more into the risk column for Microsoft or not?
So it's really interesting because Microsoft is taking steps to diversify their exposure to the AI ecosystem. Last quarter, we saw Anthropic come onto Microsoft Azure for the first time. We're also seeing Microsoft invest in their own, what they call off-frontier Microsoft AI models. Each of these steps diversifies the ways that Microsoft can win, independent of whether OpenAI is doing well or not. With OpenAI in particular, what we did see last night is that $250 billion contract that was announced about 3 months ago now. You're now starting to see that in the backlog, and that will roll on over time. The other positive catalyst to look for is the Fairwater data centers. They're coming online over the course of a multi-year timeframe, but we'll start to get more visibility into that as we go through the next 2 quarters.
We've had a bit of visibility about the silicon strategy. We've had visibility about sort of the hardware side, but ultimately this company is getting caught up with software negativity. What about Anthropic coming out? And yes, we see relationships, partnerships, but a co-work offering that could just knock Copilot out the water. How are you thinking about competition right now?
Yeah, the burden of proof will be on Microsoft being able to show that the quality of outputs in a knowledge worker desktop and a knowledge worker environment are better than what the competitors can provide. One of the key reasons they may be able to do that is because they're already entrenched in the Microsoft ecosystem. We already use Microsoft Excel, Outlook, PowerPoint,
exactly.
a whole suite of apps. And so if the intelligence that's embedded in those apps can be married with the intelligence of the LLMs, you get to a better point from a productivity standpoint than if you bring in a third party.
Exactly. I'm so pleased we're going to this conversation. This has been so focused on earnings and like classic Bloomberg stuff. Like, I grew up in the generation of people that learned computers using Microsoft Word and Excel and PowerPoint, et cetera, et cetera. Irrespective of what I use today, I don't use that. I use ChatGPT, Gemini, Claude. The totality and functionality of those platforms makes that kind of suite of software obsolete, and I'm certainly not paying for it. How big a sort of existential question is that for Microsoft? And how reliant is it, sorry to have a long question, how reliant is it for Copilot being a success, therefore?
Yeah, I think there are multiple ways to tackle this problem. I do think there is a disconnect between the consumer-facing market and the enterprise-facing market, where we see this at our own organization. In order to get really good AI tools in the hands of people who work at enterprises, you need enterprise-grade security, reliability, depth of functionality. There are a number of systems that have to ultimately connect to build you something that is sustainable and durable over time. So I do think Copilot is one of the key ways that Microsoft is addressing this problem, but there's also something like Foundry. Microsoft Foundry allows you to actually benchmark LLMs against each other and pick where you are on the frontier of cost and performance in a way that's quite differentiated today. And so there are multiple ways, whereas at the infrastructure layer, the platform layer, the application layer, over time that will come together. And one of the things that we wanted to highlight today is just the strategic totalness and completeness of how Microsoft is thinking about this.
Yeah. Gabriela Borges of Goldman Sachs, it's been brilliant to have you on Bloomberg Tech.
It's my pleasure.
Thank you so much.
Thank you for having me.
Let's get over to Meta. Thank you. Shares of Meta right now on track for their biggest jump since July. The social media giant has eased some of Wall Street's concerns about its massive AI spending after beating expectations in the holiday quarter. But it's all in the outlook. Joining us is Shweta Kajuria, Managing Director of Global Internet at Wolfe Research. An outperform rating on the stock. Price target $850. $135 billion of capital expenditures at the top end, but also enough growth in the core business aided by AI to justify it. Is it as simple as that?
I think so. Well, first of all, thanks for having me, Ed. I think the key question getting into the print was, well, Meta is one of those companies that is spending a lot of money, not only on AI headcount, but also on capex, and they have yet to show something for it. Well, this is a quarter where they're showing it, where the first quarter guide of over 30% year over year on a reported basis is the highest we have seen since the third quarter of 2021 in over 4 years. And at that time, Meta's business was about half the size as it is now. So this is best in class, remarkable growth rate. So the point is, if it can accelerate to this level, even if the growth decelerates going forward modestly, they have enough monetization levers that seem durable because they're making so many changes to their own models that are driving impressions growth and ROI for advertisers, in addition to potentially new monetization beyond advertising revenue that will come on because of their AI models over near to midterm. And that is giving comfort on, okay, well, maybe they are spending to sustain a pretty healthy level of top line growth.
Meta is not a hyperscaler, but something interesting Caroline brought up with our last guest, Gabriela from Goldman, is, Microsoft tried to talk up all the benefits it's feeling internally from allocating compute and investing. Susan Lee talks about exactly the same thing. Engineering output internally is up 30%. Is that a data point that you look at and say, okay, I believe you that this is worth it because internally you're doing better as well?
Yeah, absolutely. One of the metrics that we do track is headcount growth. And so what we are seeing is, and what we expect is headcount growth to moderate going forward, even though it will be in the positive territory, but more moderate, as well as compensation skew to shift more towards engineering and higher compensated employees. In return, what we expect to see is a perhaps greater level of productivity or shipments of products and new features that we think will then drive further ROI for advertisers and in exchange drive impressions growth, engagement growth, and then monetization. That's how we see this play out.
What a difference the quarter makes, and how much we beat up over capex last time. And this time, we see the optimism and the driving forward. The promise of AI that understands us personally is how Mark Zuckerberg was talking about it. But how crucial is, therefore, the next iteration of their large language model? How important is Avocado, what the code name is of what they're building, that it lands unlike Llama 4?
Well, it is incredibly important. Going into the print, that was one of the key concerns for Meta, that we haven't heard or seen a model yet when Gemini and arguably GPT-5 as well as Claude's models are way ahead. The expectation, however, is not for Meta's next model to really break the top 3 in the LM Arena rankings. It's more about Meta's models to be in the ranking in conversation of being a competitive model. If that happens, then that is a sign that they are on a good trajectory for upcoming updates to frontier models that they can leverage then for better impressions or monetization. And that should be enough to give investors some comfort.
Shweta, what excites you the most? Is it the commerce applications, the ways in which we're going to find it easier and easier to purchase using their own AI offerings? Or is it actually that we're purchasing hardware through them? The fact that billions of people can be wearing glasses and might be therefore wearing Meta glasses?
I think it's the former. They have shown a lot of competency in technology, in product development, and then also in distribution. And so this is not a new thing for Meta. When we go back and Snapchat was picking up in their product, well, then we saw Reels, and it's over $50 billion of revenue run rate. There's OpenAI Sora, and guess what? There is Meta AI's Vibes as well. And they benefit from having a massive distribution, great resources, as well as the tech knowledge and product knowledge to scale these types of products and compete. So I'm more optimistic on their ability to drive monetization, not only within advertising, because they are upgrading their models, but also beyond advertising, whether, to your point, it's agentic commerce, because guess what? A lot of Gen Zers start their shopping and they start their search on social media. So there's a huge untapped opportunity there, as well as business AI, where they don't necessarily compete with anybody but themselves in getting a lot of those businesses on WhatsApp on board to spend on their business AI product that we think is a $40 billion opportunity for them.
Shweta Kajuria, always so great to have you on the show. Thank you from Wolf Research. Coming up, more earnings, more capex to delve into. Tesla announces a new terafab build-out as it looks to make its own chips. We're going to speak with Tasha Keeney of ARK Invest. This is Bloomberg Tech.
I think in order to remove the constraint, the probable constraint in 3 or 4 years, we're going to have to build a Tesla terafab, a very big fab that includes logic, memory, and packaging domestically.
That was Tesla CEO Elon Musk outlining ambitious plans for a terafab, a chip factory for Tesla, in an effort to alleviate chips and parts constraints. Shares now down around 2%. Actually, at one point in the session, we were up 2%, and then as low as down 4%. The company's fourth quarter earnings topped estimates. Everyone looked past them. Tasha Keeney, ARK Invest Director of Research, Autonomous Technology, Robotics, joins us now. The kind of big headline for me was the capital expenditures commitment, $20 billion this year. As you know full well, it's way beyond what they might do in a typical year. So let's start with that. You know, it's clearly a signal that these things that Elon Musk has kept you guys looking to the horizon on for some time, now it's on paper. It's time to act.
Yes. Well, you know, I think the capital expenditures are not too surprising to us. We had fairly aggressive investment estimations in our public valuation model. But that's all to say, you know, I think the next 5 years for Tesla will be dominated by the robotaxi story. You know, we've previously published, we think this could be attributable to over 90% of the enterprise value for the company in that time period. And, you know, in order to put many vehicles on the road, which is their plan, they need to invest. Of course, a lot of that money is going into factories, AI infrastructure build out. So, you know, I think the story here is that Tesla, while they were, you know, second or behind Waymo in terms of a commercial launch for a robotaxi platform, they have an incredible scale that is really not matched by anyone in terms of the public announcements that they've made of putting actual vehicles on the road. Right.
On terafab specifically, you and the team at ARK know full well, a fab at that scale is a fixed cost of $20 to $30 billion. And the CFO was clear, this is not reflected in their capex forecast. But there's a reason that the industry doesn't put memory, logic, and packaging on one site. That doesn't exist, but it is Musk's proposal. How seriously are you taking that?
Well, I think, you know, he's always been a very ambitious CEO. I would interpret this as, look, he's concerned Tesla needs a lot of chips. They have grand ambitions for AI data centers in space. We think, you know, that could be a really interesting play, especially as launch costs continue to decline. It could actually be cheaper than data centers on Earth. So, you know, I think the way to interpret it is that he knows that he needs a lot of chips. We've seen him vertically integrate in the past in the electric vehicle business, for instance, and parts of the supply chain that he did not see popping up in the U.S. that they needed in the U.S. So, you know, I think this sort of fits in with what he's done in the past, albeit, yes, it's a major announcement for Tesla. So I'd say broadly that, like, I would interpret some of it as a call to action that, you know, he is looking out there at the supply chain. But yes, for now, they have this very ambitious plan. And again, I would focus on at least from a valuation perspective, on the robotaxi picture here. Of course, they'll also use those chips for Optimus, but I would focus on robotaxis.
And let's focus just on what you have told the market you anticipate. If I'm right, by 2029, what is it? The stock will hit 2,600, 88% of the company's value will be robotaxis. And you've talked about the millions of robotaxis that really could be produced by then. To that end, how integral is the XAI integration, if we're going to think about integration? Is that important for the story and the $2 billion, well, basically capital allocation that was made towards it?
So, of course, we hadn't previously accounted for that. The way that I would think of it as, on the call they mentioned, of course, they're making Grok available in the vehicles. I think the more interesting parts of the story are, of course, they could potentially share AI infrastructure investment and mutually benefit from each other. He did mention that Grok could sort of act as this like maestro for Optimus and for the robotaxis in terms of, like networking them together and sort of being the AI control center, if you will, for robotaxis and any sort of like large scale Optimus project. So that's how I would think about that investment.
Let's talk about this robotaxi unlock then. What needs to fall into place for the 2029 moment to occur from your perspective? Because at the moment, we've got just a handful in Austin that don't have someone in the driver's seat. How quickly does that scale, do you think, in realistic nature?
Yeah, so you're correct that there really are only a handful that currently have no one in the driver's seat. They did say though that they have 500 robotaxis and that they plan to double that every month. I mean, if that's true, if you look at Waymo's fleet, the last reported number we saw was about 3,000 cars. So in other words, Tesla could surpass Waymo's robotaxi fleet within 3 months. I mean, I think that's incredible if you look at the fact that Waymo launched the service back in 2019. Right. So again, I would focus on the fact that this is like unmatched scale. They're a vertically integrated player. They do not have to partner with other auto manufacturers. This also gives them a cost advantage. So in the Big Ideas presentation that we just published, we estimate that they have a 50% cost advantage over Waymo on the next generation vehicle if you compare it to the Cybercab. So this is really what matters for Tesla scaling robotaxis that competitors do not have. On top of that, they have a data advantage. If you look at Waymo's miles, we estimate they're doing around 400,000 per day. Tesla gets 17 million miles of FSD data per day that they can use to train the fleet. So that is something that competitors just do not have in the robotaxi front. And it's important, that scale is important because we think that what will drive robotaxi adoption is a reduction in the price per mile. So today, human-driven ride-hail costs over $2 per mile on average. We think at scale that could be profitably priced at 25 cents. Yeah. But the reality is there's a lot of headway in between that $2 and 25 cents to make profit.
You think it eventually cheaper than driving your personal car. Tasha Keeney of ARC, we thank you very much indeed. And a correction to myself, the safety drivers are in the passenger seat, as Ed points out. Meanwhile, let's talk NVIDIA. Still hasn't received any orders from Chinese customers. We'll talk that next. This is Bloomberg Tech. We check on these big moves in the market. Meta having its best day since July 2025. Microsoft having its worst day since March 2020. Both beat on earnings, both increase their capex. One is punished, Ed.
Okay, coming up, ServiceNow having a hard day. Kara, you spoke to the CEO. Got that convo next. This is Bloomberg. Welcome back to Bloomberg Tech. We're in it. This is it. Mag 7 earnings and the story, you know it. Capital expenditures, how do they compare to growth directly from AI? Well, in Meta's case, it was enough for the market to believe. Up by the most since July of last year, about 8%. Microsoft having a very hard day, biggest drop since March of 2020, $400 billion of market cap shared. And the reverse equation, Tesla now lower, but it had been higher in the session. A big capex number, the likes of which we've not seen before from that name. Plenty of other earnings as well. IBM posting revenue, topping estimates. Surviving, doing good in this software environment that's difficult. Comcast also moving to the upside on its earnings. And then there's SAP. Yeah, in Europe, this isn't that pretty, down 17%. Again, challenging software environment. We spoke to the CEO.
When you look back into all technological innovations which happened over the last 10 years, it always started on the hardware side of the house. Over time, it's also always the same that the real value creation is lying on the apps layer. So the investors are, of course, now seeing, hey, first, the groundwork needs to be done, but I'm 100% sure that they already understand today that the value creation at the end to arrive on the business side of the house will come via companies like SAP.
Other software names having a very hard time of it today, and one of them is ServiceNow. In fact, Bill McDermott, the CEO of that company, used to be the CEO of SAP. Check out the shares. Off by 11.5%, but this stock trades at the lowest since October 2023. The market remains skeptical of the company's AI strategies, even after it gave strong sales outlook for the current quarter. Just take a listen to what he told us earlier.
I think the most important thing is to level set what ServiceNow is all about. First, it's the fastest growing enterprise software company of all time. First to $1 billion, 5, 10, and now 15 billion plus. So that's fantastic. And we're operating at the rule of 55. They say you're world class when you're operating at the rule of 40. We're now growing revenues more than 20% and free cash flow at 37%. So it's actually a rule of 57 company. And we gave a guide that blew away everyone's expectations. So I think the key is this. We're in a category of one, and we're playing a different game. And right now, the disjoint between that successful company and the compression of the multiples is simply Wall Street putting ServiceNow in a SaaS neighborhood with other SaaS companies where they think that AI can rewrite those programs. AI can't rewrite our programs. In fact, AI makes us better, and we make AI better. We've been building AI into our model for 7 years now. We have 80 billion workflows in flight today, doing 6.5 trillion transactions. That's pretty hard to rewrite overnight. Yeah. So we're beautifully positioned, and we just announced partnerships with OpenAI and Anthropic because they understand the meaningful difference between giving enterprise access to an AI model and building that model into workflow where real decisions are made. So it's actually a win-win, and the market hasn't caught up with that story yet, but they will.
I'm going to nitpick here. When will analysts start saying, okay, revenue will grow not at 19% for fiscal 26, but at a 21% that you just delivered for fiscal 2025? When will it look out that we'll still see more than 20% growth or an acceleration in revenue growth based on how much you're working with AI to hasten the business?
It's a wonderful question because we're the only one. You know, one of the other concerns was, are seats compressing? Meaning, do you have less people buying your seats on a licensed basis? And our active users are actually up 25% when all the other ones are actually going down.
That was Bill McDermott, CEO of ServiceNow, two software CEOs saying AI has made everything better, yet both their stocks are down pretty severely. Now, Apple shares are down about 10% since their high in December, making them by far the worst performer among the Magnificent Seven. The iPhone maker is due to report earnings that include holiday season results, an insight into the impact of memory prices. Let's get to Bloomberg's Mark Gurman, the man who brings all the reporting on Apple and leads our consumer tech team. China's going to be a spotlight, right? I think let's start there and we'll get to memory prices because I read the preview and some of the third-party data. I look back at what you wrote last quarter. There was momentum in China. What are you expecting there?
Yeah, I think the momentum in China is real. I think you're going to see growth there. Obviously, they're still quite a ways away from their peak in China several years ago, but clearly this iPhone 17 Pro Max launch in China, particularly with the new colors and the new design, seems to be doing the trick there based on all the forecasts we're getting. I know the memory situation is important and everyone is hyper-focused on that, but I just want to take a step back here. Here's what we're dealing with. I'm going to just be honest. You have a company here that is lagging right now in AI, is lagging right now in products to some extent. You haven't seen a major new idea that's making a huge impact in a while. And the problem is they have this air cover with these just absolutely gigantic, terrific, unprecedented financial results. And when everything is going well on paper, when you're selling your current devices and your current strategy so well, you really don't have the inclination to go try to make major changes. And so that's the problem they're dealing with at this point. They are so successful that it's probably hurting them in the long term.
So successful that revenue is likely to jump 11% to $138 billion mark. But as you say, there's no foldable phone. At the moment, they're depending on Google for the underlying AI technology. How much will they have to talk and steer us to the next big innovation?
The foldable phone is cool, but it really doesn't matter. The big thing here is that a lot of the platforms Apple are running right now, it's legacy stuff, right? The App Store is a legacy platform. The iPhone operating system is a legacy operating system. They need to accelerate the shift to artificial intelligence, the shift to agents everywhere, the shift away from jumping in and out of applications to something entirely new. They need a shift to a stream of different AI hardware devices. Apple has been operating the last few years on, we're not going to overspend on AI, we're not going to overhire in AI. This is a bubble, it's going to burst. All these models are going to become commoditized. And maybe there will be some commoditization on the models, and obviously you're seeing that with their ability to partner with Gemini here to fix some of their problems. But AI is not going away. AI is not a bubble. It's bigger than the internet was, 25 years ago. And so they really need to shift into this new direction. And when everything is working so well in terms of sales, it's really hard to do so. It's hard to operate the current business and operate the future business. Operating on two timelines is very difficult. It's like a sports team that's winning championships. They have the best player, but they're also trying to draft, younger guys to create a next generation. And you've seen lots of difficulties for sports teams being able to do that. It's hard for Apple and tech companies to do the same.
Innovator's dilemma. Mark Gurman, you're always giving us the truth bombs. We appreciate it. Thank you very much indeed. Coming up, Delian Asparuhov from Founders Fund, Christian Garrett of 137 Ventures join us to discuss what we can expect from this year's Hill and Valley Forum. This is Bloomberg Tech. The Hill and Valley Forum. It brings together leaders from tech and politics, and it's entering its third year, at the time when links between Capitol Hill and Silicon Valley are front and center, thanks, of course, to this AI boom. We're pleased to welcome Christian Garrett, his partner at 137 Ventures, and Delian Asparuhov, his partner at Founders Fund. And both are co-founders of the Hill and Valley Forum. In fact, the other person who helped co-found it, Jacob, is now helping in the administration. So talk to us first, Christian, about what you want out of this year. How do you want to take this from a global perspective around AI?
Well, this year is our 5th year of doing the Hill and Valley Forum.
It's 5th?
It's the 5th. It started as a small dinner in 2022 during the Biden administration, and it's obviously grown to become one of the largest, if not the largest, gatherings of DC and tech leaders. I think this year is very special because it's obviously happening during the 250th anniversary for the country. And I also think this year will be a little bit unique in that we're really focused not just on technological leadership, which is the underpinning, but industrial leadership, which has been a huge focus in this administration, and then also alliance leadership. And so you'll actually have leaders there from other countries, from within NATO, and I think that's going to be a big difference, is the global scale of everyone's focus on building deeper bridges between technology and government.
What's been really interesting is how the vibe has shifted. When it was private dinners, then it was these now third sort of in public event, Delian, that now the Hill and the Valley are so much closer. I'm interested as to how you keep that contrarian perspective, how you get different voices around a table of how this can be done from an industrial, from a tech perspective right now.
Yeah, it definitely takes a lot of intentionality. I think one of the things that's been exciting to see as a shift is rather than just having discussions, this year you're going to see us actually release a set of different policy papers across different sort of industrial areas, whether that's in rare earths. There's going to be a set around biotech versus China and making sure that we don't lose that supply chain to them, as well as reindustrialization. And a lot of it is in the sort of conversations ahead of the forum with both technology leaders, leaders within the government, regulators, to understand the different perspectives and come in and align on something that actually is like a material, product that we're trying to actually use to go shift how a particular industry works.
Christian, thanks for coming on the show. It's going to be interesting to hear about what your objectives are here, right? Think back to last July, winning the AI Race Summit. The president took specific action. And what's interesting about the Hill and Valley Forum is it's industry and DC, right? That, there will be politicians and policymakers there Do you have a goal or something that you'd want to achieve? Like, what is the next action that you and your peers feel this administration needs to take, and in which domain?
I think that's a great question. For us, the fundamental goal is creating an environment for there to be a rebuilding of these bridges. That was kind of the goal from the beginning, and it still remains that. So I think first and foremost is gathering everyone together and having these open discussions, and most importantly, actually gathering people from different backgrounds. You'll see actually, Vinod Khosla, who's spoken every single year and is attending this year, has very different views on certain regulatory opportunities or certain industrial opportunities than maybe you'll have from another partner at another firm. Maybe you'll have, obviously, every year we've had OpenAI and Anthropic speak, who are competitors, but in this case, they're both aligned on the importance of technological leadership in AI. So I think first and foremost, it's gathering everyone together. We don't per se take goals or things that we think about. We really want to create the stage for there to be open debate and have a rare opportunity for there to be unity. We use the term bipartisan, but I think actually this is something that's just nonpartisan. Everyone believes across the aisle in the importance of making sure that the U.S. has technological, industrial, and economic leadership, and that is important for national security as well. And that is how we can create opportunity. And then everything else is a great forum really to have discussion and debate around.
Del, bipartisan initiative, right? But if you're being honest and you think back 5 years ago, you guys might have felt like you were probably outsiders in D.C. I don't know if that's fair, but present day, how are things different in the way that the administration and the apparatus of D.C. works with the technology industry? And how would you reflect on progress that you think you've made?
Yeah, I mean, obviously, if you look at the sort of peak divide between the two, sort of communities, that Maven program within Google, and I think it was 2016, 17, people within Silicon Valley did not want to be working at all, basically with the government. Now, obviously, look at us sort of a decade later, you have folks that actually have deep technological, sort of backgrounds, both as elected officials and within, appointed officials. So J.D. Vance, obviously being, sort of a former venture capitalist, Steven Feinberg, Emil Michael, Jim O'Neill, leaders basically, across the entire administration that bring that technological leadership. And so, yeah, obviously, at this point, when we look at the Hill and Valley Forum and some of the elected officials that are speaking, it's no longer folks with just a political background, but it's folks that have a strong technological background and obviously are now in the sort of political ecosystem. And so it is very merged, but we want to make sure that we're going to continue to keep this because the Hill and Valley Forum, it was founded under the Biden administration. In 2029, we want to make sure that irrespective of who is president, it still is a place where we can continue to maintain those ties no matter which president is in office.
And those ties or indeed reliance on some of the companies that you have backed to become ever more important in this geopolitical context. You think of Anduril, that both of you, and we think about SpaceX, which everyone's very excited about potential IPO of this year. Will they inherently deepen, do you think, Christian, at the moment? And will they deepen with other countries as well? How much more are we seeing countries in Europe still wanting to rely on an Anduril, or are you worried about that from a geopolitical perspective?
I think that one, in the U.S. or domestically, you will continue to see these relationships deepen. And really, this is not anything new. The United States used to practice statecraft. The United States used to invest heavily in industry. The United States also, for example, was a key driver in the creation of the Silicon Valley industry, right? It was the Cold War era funding, whether it was grants through research in universities or whether it was government contracts in the early days, really helped build Silicon Valley in California, and then that has obviously expanded to a global tech industry. And so I think the same trend is happening abroad, where you're seeing governments want to partner deeper with their technological sector. But in regards to governments and how they partner with each other, what we've seen is actually the focus on technology has been a key factor for that. If you look at initiatives like Pax Silica or various other initiatives, they're centered around industrial and technological partnership. And so I think United States companies will play a big role in how the U.S. and our allies work together. And I think the same way we want to see successful companies in Europe, in the Middle East, in Japan and South Korea play a big role in how they also partner with the U.S. too. So I think at the forum, you'll see leaders from companies across the globe, not just U.S. companies. And that's something that we're very excited about.
We can discuss this March 24th. We hope to be there, guys. But the president's changed how space is funded, right? OSTP now has a role. Del, we're going to run out of time, but a big milestone day for VADA. We're showing this image here. Just explain what we're looking at, please.
Yeah, so this is Varda's fifth vehicle that we sent up to orbit. We build these 300-kilogram satellites that basically manufacture pharmaceuticals in the microgravity environment of low Earth orbit and then bring those back down. What you're seeing here is a vehicle that re-entered at Mach 25 in South Australia and landed earlier this morning. Right now it's actually nighttime in Australia, so we'll be sort of picking it up from the desert once daylight hits. But we're super happy this is our successful sort of fourth landing, and we've got a sixth vehicle that's going up into orbit in about a month and a half. And so, taking what was an initial demonstration in 2024, doing this very regularly, and a part of it is, I think, enabled by some of the groups within OSTP that have made it so that the regulations around space are starting to become more centralized, more streamlined. We used to have to go to almost like 6 different agencies in order to be able to figure out basically how to operate a vehicle like this, versus the administration's new space policy starting to understand, okay, space companies can't have to go after that many different agencies.
Christian Garrett, Delia Nasparov, two of the Hill and Valley co-founders and venture capitalists, founders in their own right. Hope to see you in March. Thank you very much. Now, coming up, Amazon discovered child sexual abuse material in its AI data. The content was removed before the company's models were trained, but officials say the tech giant still won't disclose where it came from. We have more next. This is Bloomberg. Throughout last year, Amazon detected and reported hundreds of thousands of pieces of content from its AI training datasets that it believed included child sexual abuse content. That material was removed before the models were trained. But child safety officials say the company has not provided them with information about its sources that could be helpful to law enforcement. In a statement, an Amazon spokesperson said the training data was from external sources and the company doesn't have the details about its origin that could aid investigators. Bloomberg's Riley Griffin reported on and broke this story. I think let's start with the very basics of what this entity that we reported with saw in the data when it came to specifically the AI-related reports of child sexual abuse material. Just start with that, please.
Yeah, so there's an organization called the National Center for Missing and Exploited Children, and it effectively serves as a clearinghouse, fielding tips from industry of child sexual abuse material to law enforcement. This is a really important part of the process because this is the connectivity that allows local law enforcement agents to actually track down children who might be in active danger and find the perpetrators of abuse. They field these reports from companies like Amazon, and when hundreds of thousands of reports came in, they typically expect details, location data, sources. Where did you find this data? And Amazon has not shared that detail, which has stunted further investigation.
Is that why Amazon's data is seen as some sort of outlier here, Riley?
Yeah, so NCMEC, the clearinghouse, has been tracking this broader bucket of AI-related reports. That can be AI-generated child sexual abuse material, exploitive conversation with chatbots. It could also be known images of abuse that have existed on the internet. And ultimately, this bucket is rising. This year, 2025, was the first in which they saw 1 million reports of AI-related child sexual abuse material. And Amazon drove the vast majority, so hundreds of thousands of those cases. That's what makes it an outlier here, in addition to the lack of information.
This is a story about how artificial intelligence is changing the child safety landscape. And in the course of reporting, you spoke with a wide range of experts in this field. What are the risks that they are warning about and I suppose the solutions?
Yeah, one expert said when you hoover up a ton of the internet, you're going to find this kind of material. The internet can be a dark place, but it is on the companies themselves to ensure that their training data sets are clean before they train their models. The risks, of course, Ed, can be that the models learn these kinds of behaviors. They can reproduce those images. They can continue to retraffic images of abuse. And so questions that we have for all companies right now is how are they ensuring their data sets are clean?
As we see, Amazon has responded to your reporting. What do you think the next steps are, Riley?
Yeah, we still don't have answers from Amazon on where the actual training data came from. It'll be interesting to see when we get full data in March from the company and when we hear more from the National Center for Missing and Exploited Children as about the broader landscape. But for now, the question lingers. Caroline.
Riley Griffin, important reporting on how this landscape is changing very swiftly and downhill for child safety, it would seem at the moment. That does it, though. We appreciate your time for that conversation, and it does it for this edition of Bloomberg Tech, Ed.
Yeah, Apple after the market closed, that is big, and we'll learn a lot about the world memory prices through to the markets in China. Earnings continue. A lot to recap on in this episode. Check out the podcast. You know where to find it online on Apple, Spotify, iHeart, and of course on all of the Bloomberg platforms as well. Thank you for tuning in from New York City and San Francisco. This is Bloomberg Tech.